Hey, it's Patrick Muntz. I'm here with all you great people. I'm so delighted you showed up. It was sort of a last minute thing, I understand. Uh, we're going to do mortgages and interesting mortgages in credit, uh, a sort of a did you know type of thing. And so it's the beginning of our presentation. It's Patrick Muntz, your mortgage whiz, and we're here to help people, investors and businesses, get the commercial loans they need. We don't give legal or accounting advice. Hello there, Mr. Gerald Franklin. How you doing? I want to just let everybody know we don't give legal or accounting or any other kind of advice. Always consult with your attorney, CPA, or others for advice prior to any investment. Don't sue us, sue them. Did you know most consumers are fearful to authorize more than one credit pull because they fear it'll have a negative effect on their score? Many prospective home buyers are even more sensitive to this today, given many stricter credit score standards from lenders that result in the coronavirus economic downturn. The real truth about inquiry impact. With the FICO scoring models, the mortgage inquiries, they're not considered for more than 30 days. People don't know that. It's kind of an interesting phenomenon. The rule sometimes is referred to as the 30-day exclusion rule. Multiple mortgage inquiries occurring within a short period of time are only counted as a single inquiry. This is kind of an important concept to understand because there's a lot of credit stuff that is sort of wonky, and we're going to talk about that. The most important thing is to realize that after 31 days, it's definitely old enough to be considered by some bureaus as not a single inquiry. Only one additional inquiry might cause a score to change, while in other cases, it might take 3 additional inquiries before there's an impact. The effects depended on the credit report bureaus, the borrower scorecard, and other information reported in the credit file. This holds true across all 3 of the major credit bureaus, Equifax, Experian, and TransUnion. Did you know that there are different types of credit reports? Yep, there are different types, and worse, each of the bureaus each have different multiple scores. The main thing that I think everybody needs to know is, believe me, that FICO's credit score pulled through your credit card company probably isn't the same one that your lender is going to consider. And here's why. Because they all have different criteria in each of the different bureaus. Most people have the information in each of the 3 major bureaus, and they calculate FICO credit scores. But some of the bureaus don't subscribe to the FICO model. Their data might be slightly different, which can lead to variations in scores. Kind of, I know it's complicated, but it's pretty easy to understand if you realize that they're all competing with each other and want to maintain their own identity. So they follow different algorithms and they reflect different stuff. Some drop stuff, some haven't dropped it. In addition, these FICO updates, scoring methodologies over time result in many potential scoring models for lenders to consider. In fact, if you go to the Consumer Financial Protection Bureau, the CFPB, which controls all the mortgages for 1 to 4 families, it indicates that FICO has offered more than 60 scoring models since 2011. But before you start worrying about pulling dozens of different credit scores and getting involved in worrying about this, there's one saving grace. Fannie Mae and Freddie Mac are the rule setters. These are the government-sponsored enterprises that purchase most of the mortgage loans originated in the United States, along with FHA, HUD, and USDA and VA. They've set set the rules for the loans that they buy. So while your bank may have its own policies for particular types of loans and goes with different credit bureaus, they're likely to comply with these standards that set by Fannie and Freddie because they want liquidity. They want to sell these loans. And the biggest challenge is that if they don't, they're very compromised because they need that liquidity. So I apologize for this light show that's going on through my blinds. The sun is blinding here, and I've got it screened off as best as I can. So I appreciate your understanding. So Fannie and Freddie require these older versions of the FICO credit score. Since the score is pulled by your credit card company, it's a newer version, and it might not be the same as the older version. To get a copy of the right score, you'd have to purchase it from myfico.com. That's myfico.com. However, I wouldn't run out and purchase your score just yet. The main thing I find is that I'm trying to follow a little bit more of some of the thoughts that I've kind of put down. If the score pulled by your credit card company or free credit score websites like Credit Karma is excellent, the older version of your score is probably okay. The older version of your score is probably as well. If the score is low, you can use the newer version of your credit report to make the changes to improve your score before paying for an older version. So when purchasing your credit scores, some people like to pull their own scores or go to Credit Karma or different sites that charge them. Always opt for 3 bureaus unless you know which agency your lender plans to use. So the 3 bureau report is called a tri-merge. And that's crucial to know. So if you want to see what your loan officer or we're going to look at or whoever's going to look at it, you have to realize that if a lender pulls 2 scores, they're going to take the lowest. If there's another entity there, they'll take the lowest of all that group. In other words, you bring in a partner and there's 3 signers to the deal, a significant other, yourself, and a general contractor who comes in the deal or whatever. They're going to take the lowest score of the 3 of you. So be very careful who you put on the mortgage if there are people with impacted scores. Or they might use the middle if they pull all 3, but the likelihood is very low on that now at this point. So of course, you're going to want to be able to determine exactly what you can do before you pay for these type of reports. And the only way you can do that is to really be mindful of the fact that the FICO scores are different and there's competing versions of the FICO scores between the 3 bureaus. So now let's talk about the best investor financing, because that's why most people are here. I just talk about credit because of the pandemic, so many people have been impacted. And I mean, so many people have been impacted. So if you want to get the best financing, obviously you need the best rates. In order to get the best rates, for a conventional, for example, you'd have to go, this is crazy, but you know, the majority of people who get funded are in 700 score or more. And that's 75% of the people who apply for conventional loans. Now, it's a little different if you're going with a VA. VA has no minimum credit score. However, one of the challenges is that they have lenders who are designated lenders who protect themselves with overlays because they're not guaranteed loans. The VA underwrites the loans but doesn't guarantee them. Same thing for the FHA. They say 500, but if you're not 620 or 640, it's going to be tough to get the kind of deal you want. Well, why is that a problem? Oh, by the way, same thing for USDA. USDA, like VA, is no money down, but the lender can change the rules on you based on the scores. So you're not getting 3.5 on an FHA, for example, if your score is below 640, let's say, or 700, depending on the lender, 620 maybe. So it's crucial to realize that there's all these floating moving parts, these components, and if they don't get, if it doesn't, surface that way, sometimes they'll change the debt to income ratio on you, where instead of 36, or getting 50, they're looking at, a lower DTI rather than higher. What do I mean by DTI? That's debt to income. That means that the more debt you carry, the less you can buy. So you don't want to put your foot in that hole in the street. So let's go back to this financing. I just wanted to bring some of this criteria up so you get the flavor for what I was talking about. And again, thank you so much for joining us. We've got fix and flip out there, which provides capital for the acquisition and construction costs on investment properties, 1 to 4 family complex, fourplexes, tries, whatever. And the condo conversions, you can do it down to the studs rehab or simply cosmetic repairs. We can fund maybe anywhere from 70 to 100% of these costs. And we can also handle up to, in some cases, up to 125, but not after repair, because they're going to use the lower of the two, the acquisition cost of the appraisal. So that is the bugaboo for the investor, is the fix and flip, where if you got it at the auction or an off-market source and you paid $4,000 for that property, it's going to appraise for $4,000 based on the state it's in, obviously. So that's something to consider in terms of the loan to value that you're looking at, and it reflects itself in this funding that comes out there. The good news is that these are interest-only payments, and sometimes you have to go to private money if the fix and flip formula doesn't work for you because of the super low deal you got at the auction or what have you. What we find is maybe the average property that's purchased in an urban environment like Detroit, for example, would be maybe 35,000 in repairs before it's a rentable standard. If you're going to fix and flip it, you might want to bring it up to 60 because people's expectations are a lot higher from a purchase standpoint, especially with all the dynamics between the lack of supply and the amount of people bidding for these properties. So it's incumbent to remember that there's some moving parts here, and we'll help you work it out. We'll work with you through this, and if we have to go to a private money type of deal, then you would be thrilled to know that we can do it, but the challenge is that you want to walk in there with good credit and some cash reserves and some skin in the game. So they're looking for equity from the investor to some degree. So I'm just sharing with you, what you already know probably, but I just want to bring this to your attention that these type of acquisitions are flexible and they're not just straight ahead all the time. The acquisition only, we can provide up to 75% of the purchase for the next investment property, and loans rely solely on the acquisition of the property, giving you the flexibility to fund and manage the construction process yourself. The best deal for you, all of us, And what we try and do is put you into something that is maybe based on a line of credit, but not necessarily a second mortgage, where it's instead of a term loan where it's a straight installment, it might be a loan like similar to a HELOC, but a line of credit, which would be the best in all possible worlds because you don't have to continue to refinance it, which is good for you. And what we try and do every time is match you up to the right financing because it's the right thing to do. The rentals, if you're building your rental portfolio, we have a rental loan program. You can secure, buy, and hold investment properties for long term with no seasoning period required. We offer pretty low rates, somewhere in the range between 4 and 7, depending on what it is. Lower credit requirements than the banks, and free underwriting. So reach out. We'll give you a complimentary, no obligation loan breakdown from a straight shot and help you out. You'll get the flavor very quickly. If you have portfolio or you need blanket loans or anything like that, based on what you've got, you're looking for a cash out refinance. If the property's in good shape in a decent area, I would target that. Just like the credit, if you can stay in the stronger, better areas where people want to be as opposed to have to be, I think you're much better off. I know the temptation is to go for the lowest hanging fruit that's the cheapest. But in this regard, I urge people to consider trying to stick with stuff, nice homes in nice areas. I think that's the smart investment. I'm not telling you what to do, but I'm making a strong suggestion. Nice areas, nice homes. That way you get the rent, that's why you get the stability, and that's the way you get the funding. If it's in a war zone, you're going to have problems. And that's not coming from me, that's coming from the investors that I talk to every day. So cash out refinances, 8 to 13%, 65% LTV as is value. And we're leveraging an investment asset that you currently hold, and we want to provide funding for you for the next deal. And we could also look at alternatives. There's, if I can get you into an agency funding. When I say agency funding, I'm talking about Freddie, Fannie, renovations, things of that nature. I'm talking about the best deal for you. That's the best deal. But if we're dealing with auction stuff, very difficult to do without private money or private investors or fix and flip type of funding, things of that nature. Hey, thank you so much for coming, everybody. Another new edition. Great. Thank you so much. What a pleasure. So we were just talking about some of the best investor financing and trying to zone in on it. But before that, we had like a little thing about credit. And what we're trying to do is get everybody to understand that location is just as important as credit. And anybody who thinks that's not going to happen is needs to get in sync with that, because you can get funding a lot easier and a lot more of it. And that's what I think people are looking for. So what we run into are people that maybe invest in areas that are struggling, that are bruised or target areas. That's when people go get bridge financing to pull cash out because they need to bring the property up to a certain level where they can get a refinance. They call that gap funding as well. But the bridge financing is available in a lot of scenarios for people who are working in more commercial stuff as well. It's not just for fix and flips or medium size single families or duplexes or 1 to 4. So the medium to large developments are available. We can do those. If you know builders or general contractors who are looking at court town projects or things of that nature, we can do that. We can do the condo conversions. We can do apartment multi-units, mixed use commercial. I just left a site today that is thousands of square, like over 230,000 square feet. And I can get that building for $25 a square foot, which is unheard of. And I know the building's been taken care of because I walked through the mechanicals today for 3 hours. So there's stuff out there, different stuff. But I mean, think about that, how that would work for somebody with a assisted living situation or whatever, or just a straight up apartment conversion is currently an office building, but adjacent to a lot of amenities, including a commuter train. So there's a lot of interesting stuff out there right now, and there's going to be a lot more and within the next 3 to 6 months. For refinancing, we can, pay off your existing loan. If you've got commercial financing, and what I tell people is that to be an investor, one must invest. To be an investor, you must be in business. So you need an entity. You must run everything through this business where everybody's trying to avoid taxation is fine, but the lenders believe it. So if it doesn't show up on your Schedule C, then I wonder what can it be? Because they're going to be looking for 2 years to 3 years up there, or they can do other loans. We've got stuff where I can do instead of 24 months bank statements for cash flow to try and create offsets. I can do 12 months bank statements, and I don't need every page. There's a lot of stuff happening out there that's moving towards a sort of asset-based lending, but they want to work with the investors. But they're not doing it for free. But the easier they make it, if anybody's dug themselves a hole, in credit or is in deep targeted areas that are being driven out by other people that are rehabbing the properties because they got tons of capital, then you need bridge financing. So all the levels of fix and flip, the acquisition only, the rentals, the cash out refinances, the bridge financing, the refinancing, all come into play, and it's driven by credit and it's driven by location. I hope I'm not harping on that too much, but it's imperative that everybody understand that. You don't have to get everything for 2 cents on the dollar. Try $25 a square foot or whatever you can get. But I just want to talk to you and point out that there are some inconsistencies in people's thinking because the low-hanging fruit is so attractive. And like I said, the auction stuff is great, but it puts you in a bind. It puts you right into the arms of people with private money. Now, is that bad? Not necessarily. I'm just letting you know that there are a lot of people out there that need to learn who you are so they can trust you, and then they can get you into situations where you can move quickly and move ahead. One very good factor for people out there who are wholesalers is through the private money situations that we work, we can get you what's known as transactional funding, which is really an executive form of funding that's through private money. It's exclusive and it's very local. And these are reasonable rates, and the points are very reasonable. I think it's 3.99 points or something. So we're looking for customers. We're not looking for anything else. We want to help people bridge the gap. Why would somebody want to be a wholesaler and do transactional funding? The reason you want to do that is because you don't want the seller to know what you're paying, and you don't want the end buyer to know what you're paying. Let me say that again. You don't want anybody to get up and walk away from the table because they're pissed off. So the way you avoid that is to do off-sheet financing where it doesn't show up on the HUD because they've inverted the order and sequence of the closing. Very difficult to find nowadays. People have been burned by this, and there's a lot of people from other countries working the wires and trying to steal money, and a lot of goofy stuff. But that being said, this is a great option that we can provide for you. And we, once again, we put you together with the right product for you. So what you're doing is renting the money for 30 hours or 3 hours or whatever it is. Pretty attractive. If you're a developer, if you're looking for funding for new construction ground up, we don't like what we can't control, but we're here to help if that's what you want to do. And we can do big projects. We're doing some projects for people who are looking for funding for large assisted living environments. And based on their track record, it's not going to be a problem. One of the guys has done $3 billion worth of work and enterprise in the past 25 years. So there's people out there that know how to use these funds and actuate them. So we need to talk about your next development deal or somebody that you want to reach out to as JV partners, things of that nature, and raise the bar a little bit. Let me share a little credit juju with you and see what we can do to raise some scores. And in your case, maybe you don't need it. It's quite possible you don't need it, but it's based on what I'm seeing. I get a lot of calls from people, no matter how whole they are and how well they're doing, they sort of need it because of DTIs, the debt to income problems, because they're closer to 640 than they are 700 or whatever it is. And they're not looking at FHA, they're looking at conventional. So you got to hit 700 on conventional or you're going to have a tougher time. I just want you to know that. It's banks, it's everybody. It's these overlays that they've got. So let's talk this credit juju. How to raise your credit score. Whenever you get a free credit report on yourself, such as Credit Karma org, you should know that Credit Karma org is totally free. creditkarma.org, I should say. But it's only a general approximation of one bureau's credit report. It's not a tri-merge or an authentic mortgage credit report. It's a snapshot of your credit from one bureau. It's an indicator. A lot of people are very glib about it and say, go to Credit Karma and send it to me. Well, if you're renting, that would work, but not much farther than that. And it depends on the landlord, I would imagine. Depends on how sophisticated the landlord is. But you're entitled to these free credit reports every 12 months from the three major reporting bureaus, Equifax, Experian, and TransUnion. The only way you can receive a free individual bureau report is to go to each one of these, but go to www.annualcreditreport.com. www.annualcreditreport.com. It's the only source authorized by federal law and safe to use. But you have to ensure you're on the correct site before you order your free report, because you get one thing wrong and you're going to have a lot of other credit reporting bureaus that are hoping that you'll make that mistake. So it's www.annualcreditreport.com. Don't worry about checking your own credit report. That's what's known as a soft pull. It's not an inquiry about new credit, therefore it has zero effect on your score. And while we're talking about it, since some people came on a little later, when you do the credit report pulls, they last for all the reports go within a 30-day period, and it's a soft pull. The second you go to 31 days, i.e. over that 30-day mark, there's a high likelihood that it will be a hard pull and a hard inquiry. And it takes a year for that to come off. So you need to know that. Usually with these tax delinquencies and stuff, we see a lot of inquiries, 3 and 4, 5 and 6 inquiries. And that can hang on to people forever. It's very difficult.